This is Cece. Welcome to the Orbit. It is Thursday, December 28th, the second to last trading day of 2023. Once again, we have low IV for the last 2 days into year end. That has been a common theme over the last week and a half especially, but we have been seeing low vol now for a month and a half or more. And that looks to continue even into next week. More on that in a second. But we've got a 0.4% expected move. That's about 17 IV. The 0 DTE IV tends to get cranked to keep that expected move from getting too narrow, especially at these low vol levels. But you'll see as we go into next week, next Monday or Tuesday, following the 3-day weekend for New Year's, we see very low vol of 9, and that is basically market makers protecting themselves from getting plugged with premium into the long holiday weekend. Now, next week is also being treated somewhat as a holiday week. We see that continued low vol. It starts to pick up towards the end of the week, and of course we have the first bit of economic data start to kick in again for the new year. We have the non-farm payrolls number on Friday, and you start to see that sort of is the beginning of vol picking up a little bit, but again, we're talking very low vol even into January, and we will start to see earnings reports towards the end of January as well. So the name of the game, as we've been saying, is if you are positioning directionally or you are looking for hedges out into 2024, the options market is not charging you much for going out even a few months. We're looking at February, we are at 12 IV out there. From a trading perspective, that means put spreads, call spreads, and in these conditions with low volatility, especially at the money, low volatility, the wings and the extremes will get bid up a little bit. They will get skewed both ways, and that's basically because those market makers do not want to be selling 11 or 12 vol or 10 vol or 9 vol out in the edges of that move curve. Now, obviously, if you are playing for a large move in either direction, or you are looking for protection against positions and you need that protection for a long way to the downside, then start looking for puts to the downside as hedges or calls outright. And then you have the potential, if you do get that move in the beginning of the year, you can then spread that outright call or put. And that's another way to look at this low volatility. Going to the QQQs, we've got it up slightly in the pre-market. The 0 DT expected move is 0.4%, which is quite low. That's the lowest we've seen the Qs in quite some time. IWM, we've had our eye on for a while. That is pretty significantly above that 200 level now. We are looking at about 204 pre-market. It's down a little bit pre-market. Keep an eye on this. If this is the potential for that escape velocity from 200 level to the upside, or whether it fails and comes back towards 200, but 200 might be acting as support at this point. We'll see, but we want to keep our eye on IWM because that could start to signal, especially at the beginning of 2024, any sort of developing froth in the market, and you could see a bunch of, up until this point, it's been playing catch up, but it could be a leader as people scramble to catch up and have that fear of missing out of some of these small cap names ripping higher. We will see. That has yet to be decided. And finally, I wanted to take a quick look at USO, as oil has been quite volatile recently. You can see this on the 1-year chart. So we're looking at the expected move, and even into tomorrow, it's about 2%. So this is whipping around a lot more than the stock ETFs, obviously. Going out to January, let's go to February. And the monthly February expiration, that is about a 9 to 10% expected move.